The broadcast is now starting. All attendees are in listen-only mode.
Yeah, hello, it's Brent Doherty here, Senior Account Manager at Forex Capital Trading. Today's webinar is going to be on trading the Aussie dollar. I hope that everyone listening is well and that your trades have been going successfully. General advice warning. The following education session is not to be treated as personal advice. ForexCT provides general advice only that does not take into account your objectives, financial situation or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets. So, what are the characteristics of the Aussie dollar? Well, the little Aussie dollar is actually the fifth most traded currency in the world, behind the US dollar, the euro, the Japanese yen, and the pound sterling. And there are a number of reasons why it's so popular. Probably one of the most important is the relative freedom of the exchange market from Reserve Bank of Australia and government intervention. Since the dollar was floated, there's been relatively little intervention in the way that the Aussie dollar trades against other currencies. So a lot of market traders like that. It's also very attractive because of the stability and strength of the Australian economic and political systems. Australia has had 26 years without a recession, which is a world record. Also, the relatively high official Australian interest rates attracts investors attracted to the carry trade by taking advantage of interest rate differentials between central banks. And also, it's increasingly becoming popular as a diversification opportunity. People that want to have a balanced currency portfolio, like the AUD, because of its exposure to the commodity cycle and also the dynamic Asia-Pacific economies. So there are a number of reasons why the Aussie dollar is so widely traded around the world. Now, the history of the AUD was it was introduced in 1966 after the Australian pound was replaced by decimal currency. Now, it was floated in December 1983 in a very radical move by the Hawke-Keating government. And what happened then was that fixed exchange rates were abolished. So now the price fluctuates freely based on international money market supply and demand. Now, this was a truly revolutionary act by the Hawke-Keating government, and it's had a huge impact on the way that the Australian dollars trade now that they've removed from the fixed exchange rate. So that's one of the reasons why the currency is so attractive. It's also attractive because the Australian economy weathered the 2008 global financial crisis due to the mining boom and high commodity prices, and we're the only major economy not to go into recession. So that strength of the Australian economy during the global financial crisis was reflected by the heights at which the Australian dollar went over most currencies during the GFC. And if you have a look at this chart here, you can see this is in December 1983 when the Australian dollar was first floated. And as you can see, initially it had a slow but reasonably steady decline till it traded at its lowest point at 47.75 in April of 2001. Then you've had the Australian dollar has strengthened, particularly when the global financial crisis occurred in 2008. Where it reached its highest ever level in July of 2011 when it was trading at $1.10 against the AUD USD. Then it's with the improvement of the global economy and also the US economy recovering from the recession, the AUD has gone into a slow period of decline until roughly around the start of the year. Then, due to several political factors, which we're going to go into later, and the weakness of the US dollar and the Trump administration, you've had since the start of the year, you've had a rise in the value of the Australian dollar until it's reached the heights that it's now trading at. So the trading fundamentals of the way that the Aussie dollar operates is that it's very sensitive to commodity prices. The rise or fall of commodity prices increases or reduces the value of Australian exports, which would most likely affect the Aussie dollar. It's also traded heavily as a proxy for the Chinese economy, which is now the second largest in the world. Because the Chinese currency is pegged, it's very hard for traders to trade successfully against Chinese economy. The Chinese currency. So for that reason, the Australian economy is traded as a proxy for the way that China's going. So a weak or strong Chinese economy or economic data coming out of China that's a positive or negative can affect things such as the level of Chinese commodity imports, which could affect the price that the Australian dollar is trading at. Now, the other thing that affects the way that the Australian dollar trades fundamentally is the Reserve Bank of Australia and monetary policy decisions. Now, the RBA usually prefers a lower AUD, normally around the 75 to 77 mark. Cent mark, because it helps to boost Australian exports by making them more competitive. If the Australian dollar is relatively weaker to other currencies, it makes our exports cheaper when we try to export overseas, which gives us a competitive advantage over other countries with higher currency rates. So even though the RBA now rarely intervenes directly in the market to try to increase or reduce the price at which the Australian dollar is trading, they often do a technique known as verbaling, where they'll talk down the Australian dollar if they think that it's gone too high. And that actually happened with when the Australian dollar climbed recently up to the to the 79 level and beyond. The Reserve Bank, the governor, and several senior officials in the bank actually downplayed the Australian dollar, which did have an effect of dampening the rise. So at the moment, they're not doing anything directly to intervene, but certainly the RBA would prefer a lower dollar. And by the way, their policy pronouncements and also things such as speeches and interviews by RBA officials, they've tried to downplay the Aussie dollar. Now, some of the key AUD data reports that are going to influence the way that the Australian dollar is trading. Obviously, the most important is interest rate decisions regarding monetary policy by the Reserve Bank of Australia. And it's not just the release of the official interest rate decisions on the first Tuesday of every month, but also, the market will react to things such as the release of minutes by the Reserve Bank Board, giving them insight into how they think the Australian economy is going, and what the implications of that are for current and future monetary policy, and also, as mentioned before, by speeches by RBA members, and in particular the governor. Now, another key economic data that influences the way the AUD is trading is inflation data such as the CPI or the PPI. Generally speaking, higher inflation would put increased pressure on central banks to raise interest rates to slow down the economy. Raising interest rates traditionally will affect in a positive manner the domestic currency, and lowering interest rates to stimulate the economy will usually have a dampening effect on the home currency. So inflation data is often eyed keenly as a key to the pressures on central banks in terms of what they're going to do with monetary policy and the subsequent effect on the currency. Another very important factor is employment figures. Recently, Australia has had quite healthy employment figures, a big rise in the number of full-time jobs, and an increase over and above market expectations on employment numbers. So those sort of healthy employment figures have been one of the reasons why the Australian dollar has been coming up in the last couple of months. Another important factor is retail sales. Obviously, with people spending more, there's more money flowing around the economy. Retailers are making money, hiring more employees, so that will have an effect as well. And a decline in retail sales figures shows a slowing down of the economy. House prices is another very important indicator. Obviously, Australia has entrenched high house prices, which can be a limiting factor in the economy. So data such as house prices are watched very keenly by the market to give an insight into how the AUD might trade. Another important economic data is industrial manufacturing production. Obviously, if industries and manufacturers are producing more, that means that they're obviously think that the economy is doing well and that they're going to be able to sell the goods that they're producing. So that will give an insight as well into how the Australian dollar and the economy is performing. Another one is trade balance. Healthy trade balance makes the Australian dollar more attractive because it's indicative of a healthy economy. A decline in trade balance figures would tend to have a negative effect. And finally, and just as important as all the others, and in many cases even more important is Chinese economic data, especially trade data, purchasing, manufacturing, indexes, surveys, and also interest rate changes. The Australian economy is very heavily tied into the Chinese economy. The Aussie dollar is traded as a proxy. So obviously, if weak economic data would indicate that there might be a decline in Chinese demand for Australian commodities, which is obviously going to have a flow-on effect to the Australian economy and the Aussie dollar as well. So for that reason, Chinese economic data is very closely watched by the market if they're looking at how it's going to affect the Australian economy. Right. So now another very important factor, and probably the most important factor, in fact, on how the Australian dollar is trading is the interest rates. Now, on the first Tuesday of every month, the RBA announces the official interest rate figure. Usually the week after that, the minutes of the board are released, which gives an insight into government monetary policy. What does the RBA think about the Australian economy? Are they worried about the future? What's their thinking about what interest rates are likely to be? So that sort of data is watched almost as closely as the official interest rate decision. A decision to raise interest rates is based on a number of factors such as inflation, GDP figures, and the trade balance. Usually a hike in interest rates puts upward pressure on the domestic currency and vice versa if interest rates are lowered. So that's one of the reasons why inflation figures are watched so closely, because of the relationship they have with official interest rates and the possibility of any movement in the Australian dollar. Now, in general, the last RBA meeting minutes have shown a favourable outlook for the Australian and the international economy. So therefore, RBA monetary policy seems to, at the moment, favour a steady as she goes policy, and it's likely to remain steady at 1.5% for the foreseeable future. Now, of course, the other factor is that, in regards to such as the Aussie dollar trading against the US dollar, is that several governors in the US Federal Reserve System have also indicated that they're taking a conservative approach to potential future interest rate hikes, considering lower US economic growth. So for both Australian interest rates and US interest rates at the moment, there doesn't seem much of a likelihood of change in the foreseeable future. So that's not going to affect the Australian dollar and the US dollar for the time being. So some of the technical considerations in terms of trading the Aussie dollar is that it has a much lower relative liquidity or market interest than most other major currency pairs like the Euro USD. So because there's tend to be less trading of the Aussie dollar than some of the other major currency pairs, it tends to have more volatility in price movement, particularly when Australian markets are open. That tends to drop after the London European sessions close, when the North American sessions open, and then until the Australian financial centres open again. So most of the volatility and movement in the Australian dollar will be during the day when the Australian markets are open, and then into the early evening when the European markets open as well. So what that lower AUD liquidity means is that the Aussie dollar reacts more to market events like economic data releases and some of the other major currencies. That's particularly the case when the news is negative and compared to market expectations. So, for example, economic data like an unexpected rise in Japanese inflation figures has much less an effect on the Japanese yen pairs than an unexpected rise in similar Australian figures would have on the AUD USD. Now, the other important factor that influences the Australian dollar is commodity prices. The AUD is seen as being a currency heavily influenced by commodity prices, and generally speaking, a rise in commodity prices is associated with an expected rise in the AUD. Although the Aussie dollar has come down since the end of the mining boom, Australia still relies heavily on precious metal exports like iron ore, gold, and coal. Now, currently, demand is spiking in China and India for commodities, particularly for iron ore, which is regarded as being favourable for the AUD. So the recent run of strong economic data of China showing an uptick in production and manufacturing has been very healthy for the Australian dollar, and also the higher profits that Chinese companies are making with iron ore as well is also having a very positive effect on iron ore exports, which is very favourable for the continued health of the Aussie dollar. Now, in terms of trading the Aussie dollar against its most usual traded pair, which is the US dollar, since the high of $110.10 in July 2010, the Aussie dollar has slowly declined in strength to just above 0.68 in January 2016. Now, that height of $110.10 was obviously during the height of the global financial crisis, caused by the collapse in the US subprime mortgage market. So that's a situation that's unlikely to be repeated for the foreseeable future. That it's going to climb to such lofty highs. In fact, following Trump's election victory in November 2016, the Aussie dollar fell from 75.25 to 71.57 as the greenback reacted favorably to Trump's pro-market policy commitments. And if you have a look on this graph here, this was when Trump won the election back in November. And as you can see, that has put significant downward pressure on the Aussie dollar, US dollar, because of the strength and the very favorable reaction that the market has had to Trump's election, as he was seen widely as a pro-market candidate. Now, unfortunately, the subsequent disillusionment with Trump's failed legislative agenda, such as his promised corporate and wealthy individual tax cuts, and also the non-delivery of the massive infrastructure projects that he has promised, has weakened the greenback against most major currency pairs. So, spurred by the perceived political gridlock in Washington and declining US growth figures, and also good economic data coming out of Australia and China, the Aussie dollar US dollar reached a 2-year high of $80.65 on the 27th of July 2017, and that you can see here. So right now, the Aussie dollar seems to be generally on a trend upwards. Some technical analysis is showing that it might go as high as 82 cents against the US over the next couple of months. So there are some of the different factors to take into account when you're on trading with the Aussie dollar, and also in particular with the Aussie dollar US dollar. Hopefully that will have been of help. Good luck with all your trades, and have a good night. Thank you.